Good morning, I'm Christian Pecher. I'm a portfolio manager on the JPMorgan Global Select Equity Strategy and delighted to be here this morning to talk to you. We've been asked to talk about bright spots in global equities, which, is not an easy subject given how much risk and uncertainty there is currently with regards to the global economic outlook and geopolitics and things like that. But I think we've found something. So the bright spot in global equities is the fact that things are going to finally get worse. So over the next few minutes, I'd like to take you or show you why we believe this is actually good news for investors and what you can do about this. One of the solutions to that is, of course, investing in our Global Select Equity Fund. So after 3 years of COVID disruptions, we are finally reconnecting with fundamentals. But let's start with the bad news, right? Which is that things are starting to get worse. Maybe the Fed can engineer a soft instead of a hard landing, but we do know that businesses generally are starting to slow down. And regardless of where GDP ends up, we believe that consensus earnings for 2024 are at least 10 to 15% too high. And we do believe that investors, people like you, are similarly cautious with regards to the outlook. And so this revisions of expectations back to what we think are more realistic levels is really a clarifying event that means that we can finally move forward and focus on valuations. Valuations which, after a long decade of being undervalued, of equities being undervalued relative to bonds, we seem to have reconnected again with equities largely fairly valued versus bonds. But even within the equity space itself, if we look at different markets and depending on what metrics you want to use, average valuations are about in line with historical levels. And we don't see any particular strong signals from any of the regions or from things such as the growth camps, cyclicals, defensives, value. The one thing we are observing, though, is that valuation spreads are still really wide. So the difference between the cheapest groups of companies and the most expensive group of companies, that spread has been continually widening over the last few years and is still at extremely high levels. And we believe that that spread widening creates opportunities for stock picking to add value or for active management to add value. Global Select is a core stock picking strategy offering a very balanced exposure to the best ideas globally from growth, from value, from income, across sectors and regions. And over the next few pages, I'll walk you through some of the details of our assumptions. I don't know if you can see I think there's been a bit of a misprint here, but you can see the numbers and you can see that, global EBIT margins have started to come down. If you split the economy into two sectors, right, there's the goods producing sector or the things sector and the services sector. Now, the goods part has an outsized impact or contribution to overall profitability of companies within an economy, much more than services companies. So over the last few months and quarters, as we've seen a reallocation of spending away from goods and things and all the stuff that we bought while at home during the pandemic, online, etc., as we reallocate our spending from goods to services, this is going to have a mix shift on margins that is going to lead to lower margins, almost regardless of where the GDP outlook is going to be. If we look at the far right of that page, into looking at the forecasts, or from a consensus forecast for margins, we believe that they are extremely optimistic. And we believe they're optimistic because they seem to imply that we're going to get a significant rebound in spending on goods or things, where we believe that we're only just about reconnecting to a long-term trend in these areas, and there's no real need for us to start spending significantly more than we have done historically. At the same time, we're also seeing wage inflation continue to exceed goods inflation, and both of those things combined are likely to put pressure on margins for most companies out there. Now, looking at valuations, I talked earlier that the one thing that we look at is the dispersion of valuations between the cheapest companies and the most expensive companies. And we see this as an indication of the controversy or the uncertainty in the market. Uncertainty around the long-term earnings outlook, the discount rates that people use to discount those long-term earnings, and risk premium. So with earnings finally being, or hopefully finally being revised down towards what we believe are more realistic levels, that earnings component of the uncertainty we believe will diminish over time, leaving just the point about discount rates and risk premium, which are things that it is very difficult for anybody to have long-term insights in. So what we do, within our global strategy is to focus on the risks that we understand, which tend to be stock-specific risks, at the same time trying to minimize all of the risks that come from factors and macro-type risk. And again, when we see risks or when we see spreads being this wide, but still a lot of uncertainty with regards to various risk factors, the one thing that we believe is the right way to do is to focus on buying companies of the highest quality or businesses that we believe have a really robust business model that allows them to succeed and function well through any type of macro environment, whether that implies higher inflation for longer or higher rates for longer, or slower growth in the economy for longer periods of time. How do we get these insights, or how do we get these informational advantages that we believe help us to focus purely on the stock selection, on the stock-specific risk? And the answer to that is, it's a collaborative approach based around a team of about 80 global sector analysts who have an extremely deep understanding of the industries and the companies that they cover, and who on average have 20 years of experience, and which means that they've worked through and lived through multiple different market cycles. And that's an extremely important part of investing in difficult times, because it is that experience that allows you to differentiate between cyclical drivers of companies and the economy and the structural drivers or structural change in the economy, which we all know is accelerating at an extremely rapid pace. So, we have a very long-term approach to forecasting the companies that we look at. And ideally, we try to identify the winners and losers of structural change. And AI is probably one of the latest examples of that, and one I think that is on everybody's mind. And I think if you've been following the news around OpenAI over the weekend, you can tell that it's a subject that seems to capture everybody in the industry. But more so, we believe that over the last year at least, it's becoming very clear that every business out there is being evaluated through an AI lens, where everybody's trying to decide who are the beneficiaries of AI, who are the enablers, who are the disruptors, and who are going to be the disrupted companies. Now, the answer to all those questions is very difficult, and it's going to take a very long period of time to play out. I think we've heard from Sam Altman say that we're not even in the sort of the logarithmic part of the S-curve with regards to AI development. So there's a lot of room for many companies to succeed. But at the same time, we think that the enablers of this technology shift are already quite clearly identifiable. Right? We've got companies like ASML, TSMC, who manufacture or make most of the chips for NVIDIA or AMD. And then slightly more or less obvious companies like Legrand or Schneider Electric or Eaton, who provide or help support the physical infrastructure needed to drive this type of structural change. On the downstream side, we are looking for companies that can use this type of technology to solidify their competitive advantages, their competitive moats. And I think maybe the less obvious example here being Deere, which is a big agricultural equipment company, a tractor maker. And it's a great example of a company using AI and technologies like this to drive forward precision agriculture, which minimizes pesticide and fertilizer use, which helps farmers to improve profitability and margins, while at the same time being good for the planet as a whole. Other companies that we think are, interesting and are bright spots from a global equity point of view. Volvo Trucks, for example, one of the companies that we believe is going to benefit from the move towards electrification of heavy goods vehicles, and they're well ahead of the curve of most of their global competitors at an extremely attractive valuation. I already mentioned TSMC as being one of the big beneficiaries from the structural shift towards more high-performance computing. And then one of the other companies that we think is exceptionally good value here, Amazon, where a lot of the investments that the company has made over the last 2-3 years in terms of bringing shopping and e-commerce much closer to the consumer by building fulfillment centers all across America, which really changes the competitive dynamics relative to any other e-commerce provider in the US. And now that investment is complete, we should start to see cash flow and margins within the e-commerce part of that business start to climb consistently. So, coming to the end, I think in Global Select, you have, a very experienced team of portfolio managers, and Helge Skibelli and myself, supported by an equally experienced and well-resourced research team that has delivered very consistent results over multiple market cycles in value and in growth markets. And we've done that by sticking to what we know best, which is fundamental analysis of stocks, which is what we think is also, what you need to succeed in this type of environment and what you need in order to pick the bright spots in global equities. And I will leave you with this page, and thank you for your time and attention this morning. And please come see us at our JPMorgan booth out there to discuss many of the solutions and product offerings that we have that can help you succeed in a more complex and complicated world. Thank you.